Hi everybody, I'm Aryaman, the CEO and founder for Myre Capital.
My father, like most people of his generation, had a bias for saving rather than spending. Eating out was something you would do at best once in a month. And where did he put all his savings? In residential real estate. He bought not one, but three houses throughout his working career. And I guess a lot of Indian middle class families have a similar story to tell. Now, I really think that there is a missed opportunity here of investing in commercial real estate. Commercial real estate means office space. Now, why is this an interesting opportunity that Indians miss out on? So that's something that we discuss in this conversation. And the reason why we miss out on it is the opportunity that Myre Capital is chasing. Simply put, you need to have tens of crores to invest in high quality commercial real estate because the kind of office space that an MNC would want to lease out will cost that much. So listen on to this insightful masterclass on all things commercial real estate. We talk about the trends, we talk about what can we expect in this space, and we understand how Myre Capital is disrupting this space and really creating a very unique asset class for average Indians. You're listening to the Founder Thesis podcast with your host, Akshay Datt.
I've actually been in the US for 7 to 8 years before moving back to India 2 years ago. Went alone for education purposes. So both my parents, you can say to some extent, were entrepreneurs in their time. So currently they run an established architecture practice, but of course they both were the founders and creators of the whole brand. I was very young when they were setting it up, but definitely I saw the different stages that come in setting up a business, the kind of responsibility and also accountability you have to various stakeholders. So those things I got to see in real time. So I did my undergraduate and master's from the University of Pennsylvania, the engineering school. So a lot of that was tech driven. So I did computer science, networks engineering. Eventually I did my master's in big data and systems. But simultaneously, I kept taking courses in finance and real estate for important.
And because your parents were in sort of like the real estate services space, so which is why you had an interest in that space.
Well, actually, what intrigued me is that the real estate sector in India was quite unorganized to the extent that there were large players and the barriers to entry were quite high. Being in this space for so long, what my parents, they made certain investments and those investments did well. So I was constantly looking at a way of sort of making the whole asset class more accessible, more friendly, changing the perception of the asset class and leveraging technology for it because that was my core competency and predominantly technology and real estate tend to go hand in hand much lesser than other fields. So actually, I was doing a lot of coding much before I went to UPenn, so I was very comfortable with the whole curriculum and schoolwork. So quite often I kept taking time even off from college to work in interesting startups. At one point, I extended my summer internship into a full 1 year job. My college experience wasn't so much to get through a curriculum as it was to figure out what I wanted to do. I worked at SoftBank, the Vision Fund. I even worked with the ex-CEO of Housing.com, Rahul Yadav. So he was building an entire tech backend for Anurag. So I was there from the inception of that tech solution development till the launch of it. So I took a year off from college to even do this.
Wow. Okay. Anurag is in India. So you came to India or this was like a remote thing?
So we started off remotely because this was actually at the intersection of all my interests. Eventually I realized that it's very different being a remote team member of especially a startup and being there in presence. So one fine day, I just took a flight to Mumbai and one thing led to the next and I was there for over 8 to 10 months.
Okay. And what does Anurag do? How would you define that company? What is their business line?
Sure. So they are a consultancy in the real estate field. So they look at various things. They look at a traditional broking, which they are most commonly known for, at least to a larger audience. Their own reports, valuations. But interestingly, what Anurag has done is taken a tech approach to things. You can say tech developments that they've made recently, they've come up with an AI algorithm to understand the quality of inbound leads. So, today, brokers speak to 100 leads before converting one. Anurag is trying to, via AI, filter that down to a much lower quantity of leads required to convert one. So they're trying to approach it from this aspect, and I found that very interesting. and working with the CEO of Housing.com, who's been in the prop tech space. But eventually I moved back to the US. I worked at SoftBank thereafter. At SoftBank, in fact, I saw a lot of startup space. I saw finance. So I spent my next couple of work experiences in investment banking and venture cap just to get that finance aspect of things. And eventually, when I felt that I got the required experience, I started looking for a pivot into the prop tech investment space. But eventually, I realized that the models I was looking at in the US were lacking in India. And that's where effectively I saw the opportunity.
What was the thesis? Like, what was the gap you identified that you felt there could be a business built around it?
So, sure. So there were three issues with real estate. The first being that there was too much data asymmetry and the investment size was very large for commercial. So 50 crores, 70 crores. And the point is, it doesn't matter if you're HNI or not, that much concentration risk is not ideal. So that was one. The second was that at the start of COVID, and all of this transpired at the start of COVID, your fixed deposits and debt products were not giving good returns. Even today, your fixed deposits are giving 5%. That commercial real estate becomes very attractive, where you get monthly cash flow, long-term rentals and 8 to 10% yields. That was the second part. And the third part again was something which was situational. The SEBI and RBI increased the minimum investment requirement in most alternative funds. So someone with 10 lakhs, 25 lakhs, even 50 lakhs didn't have very many investment options apart from mutual funds and FDs. That was the whole ecosystem which enabled us to come into a very niche segment, a very under-catered to segment for that matter, and effectively open access to real estate, which previously investors would not even consider.
In what sense open access? Like traditionally, middle class savings always include buying a house. So in what would you say that they did not have access to it?
Sure. So in fact, when I went and asked people feedback about their experience in real estate before starting Myre, I only heard two things. One, either they made a lot of money, or second, they burnt their hands. There was no middle ground to investing in real estate. Now, the point with residential is that you get a 2% return. Now, sure, if that area tends to appreciate, then you speculatively made money.
2% return. Can you define return? Are you talking of rental income or appreciation?
Your rental income. So, it's about 2%. Everything else is left to speculation. And more often than not, investors are not making money. I mean, the whole asset class has been quite flat for a few years, and, there's a lot of oversupply. The second avenue why people were investing in commercial real estate was through those smaller shops. So there was a lot of instability in tenancy. There was a lot of uncertainty, high maintenance cost. So again, that came with its own challenges. The traditional way of investing into real estate, where funds are participating, your whole advanced HNIs are participating, is commercial real estate. The reason for that is twofold. One, you have very long-term leases with, MNC tenants and New York Stock Exchange listed tenants, 15 years, 20 years. So that way you have visibility into the kind of rentals you're getting. Second, the returns are also very competitive. You get 8 to 10% again only from rentals. This is not with appreciation. So the proposition was something which enabled us to give access to real estate in a much more controlled, structured and safe manner when sort of diversifying into this asset class.
So what you're saying is that large sized commercial real estate is a very good investment, which a middle class person normally cannot access simply because of the entry barrier of the minimum ticket size of doing that purchase.
No, absolutely. In fact, if you see the last couple of years, what is up? Brookfield, Blackstone, all your institutional funds, they are deploying more capital in Indian commercial real estate than anywhere else in the world. So right now we're a developing country. Capital values are low and the core fundamentals of India are very strong. We're a global IT hub. So to that end, we have access to cheap and quality talent. So a lot of MNCs are increasingly setting up outsourcing centers, capability centers, research facilities in India.
And so you said that there is something called an alternative fund that also allows you to access this kind of a project, like a large commercial real estate project.
Yes, so there are alternative investment funds. These funds, the basic requisite is a 1 crore of investment. So that's the first threshold. The second and more important difference is that traditional funds like the one we're discussing, these have been blind pool funds where you give money to an investor, to a fund manager, and he allocates it as per his best understanding. In our case, we follow the reverse fact. We identify what we're investing into and then position it to our investors and ask them, do you want to invest in this or not? So the kind of transparency into the end use of that funds is far over here, and people are increasingly getting put off by blind pool funds.
So this alternate investment fund, you're saying that is a blind pool fund?
Absolutely. So that's one of the traditional funds. And yes, in some cases, they identify a sector or they identify a city. So we'll invest, let's say, in Bangalore or we'll invest in senior living. But the underlying assets have never been identified. So that again comes to the discretion of the fund manager.
So it's like mutual fund where you can say large cap, you're investing in a large cap mutual fund, but which stocks is the discretion of the fund manager.
That's the most accurate comparison, actually.
But then there's a reason why that exists, no? Because lay investor would not have the time or the expertise to make a judgment on is this a good investment or not. And so you leave it to the experts. That's the logic behind that, right?
No, absolutely. In fact, so there are a certain type of investor who prefer that. However, what we are positioning is that we're still doing all the work where we identify the property, we do the diligence, acquire, manage. It's just that we tell you what you're getting into before you invest. So tomorrow your expectations are in line with what we are doing as an investment platform. So there's no discrepancy of information. So often what will happen is a fund will project a certain return. Investors expect that return, but the underlying assets are not delivering, at least not in rental, maybe in appreciation. So then the misalignment of interest is the reason as to which people have started gravitating away from light pool funds. In fact, light pool funds today, they are getting lesser and lesser traction from institutional investors and retail investors for that matter.
But a retail investor cannot access a blind pool fund or because you said it's like a 1 crore minimum ticket size to invest.
Yes, so it is a 1 crore minimum, and the definition again of retail investor.
Okay. HNI retail.
Yeah, it gets stretched, but effectively, when you talk about retail, it's anyone who isn't investing 30 crores, 20 crores, ones who could have bought the property themselves.
There was this concept called real estate investment trust. What was that? I remember reading about it a couple of years back when it was getting launched.
Sure. So real estate investment trusts are actually a fantastic vehicle which promotes the entire commercial real estate sector as a whole. It's been prevalent globally for a much longer time, but today it's been introduced in India. We've seen 4 REITs come into the market. Now, what a REIT effectively is, a mutual fund of real estate, they have a lot of underlying property, which is yielding. Now, the rental gets passed on to the investors as dividends. And effectively, you're betting on the whole commercial real estate market. Because this is not one building, not 5 buildings. This is a scattered portfolio of billions of square feet pan India. It's more like betting into commercial real estate than of picking or winning stocks. So that's the basic difference.
Okay. And this is also closed off to normal investors, or is it more like a mutual fund where anyone can invest?
Sure. So today, I think SEBI has reduced the minimum to only 1 lot. Earlier, there was a minimum of 400 lots.
What is a lot?
Sure. So how in equities you have shares, the same shares are referred to as lots. So in REITs. So the minimum subscription or minimum investment size has drastically reduced over the last few years. In REITs, so today someone, yes, can, invest with a few thousand or lakh rupees also in a REIT. The problem is the supply, because the people who have bought this were usually institutional investors. And there's very limited supply in the market of REITs. So for that reason, whilst everyone can invest in REITs, it's difficult to actually get access to it.
And what is the rupee value of 1 lot? You said 1 lot is the minimum.
Yeah, it keeps fluctuating like an equity stock. So some stocks are like at, let's say, 1,000 rupees, some at 200, similar with REIT lots. It varies REIT to REIT and day to day.
But like a ballpark estimate?
If I remember correctly, around 400 rupees was one of the REITs. I mean, there's no significance of that absolute number. It's like a share price. I mean, that you have a unicorn company with a share price of that looks it's the same. It's the same.
And now REIT, you're saying, has not taken off really. If you're saying that there are not enough REITs available, it means there's not enough demand for it. Like it hasn't taken off as an investment class.
No, not necessarily. I mean, what happened is if a lot of investors buy it and they don't want to liquidate it, then there is no supply for the next guy to buy.
But then if a lot of investors are buying it, it would attract efficient market hypothesis.
Yeah, but setting up a REIT is not, so for example, let's say there was a lot of demand for a certain industry. Companies coming into that industry would still have to set up their companies. They would have to run their operations to a point of listing. So similar with REITs, the demand would be there today. But until a REIT becomes mature, until you are ready to REIT for that matter, it takes 2-3 years to set up and prepare for the REIT. So just because there's demand doesn't necessarily mean that there's going to be supply at that moment. But yes, we will see quite a few REITs coming into the market over the next couple of years. In fact, I think this year, 2 more REITs are planned.
Okay. And why does it take so much time? Because you need to do a lot of on-ground due diligence of plots, properties. That's why it takes time. Or is there like a approval mechanism which takes time?
No, I mean the entirety of it. So you can sort of compare this to a IPO listing. So even IPOs take months and months to plan and list. And this is after we doing IPOs for years. REITs are relatively new. You can in some senses put this as a IPO of real estate or a portfolio of real estate. So yes, there's regulation. It's relatively new, so it takes longer. Real estate also is a bit more difficult to structure in terms of holding entities and sort of FPVs and things like that. So it just takes time, but it will get streamlined and when more REITs come into the picture.
Got it. Okay. And what is the management fees in a REIT? Like in mutual fund, I think it's 1 or 2%, something like that. It's similar for a REIT?
It's 2%, I think, in most REITs today.
Got it. Okay. Okay. So essentially, what is the positioning of Myra Capital is that this is for a more sophisticated investor who would want to select, because REIT, alternate investment funds, these are all blind pool funds. You can't pick and choose one property. But if there is a more sophisticated investor who wants to pick and choose properties and yet is a retail investor, not someone who's investing 30 crores. So that is where Myra Capital comes in.
Sure. So closer and comparable, I guess, to a Praxis platform is like a private equity real estate fund. So the difference being that what they do is they acquire a certain property under market rate, and their whole return proposition is yes, rental, but it's also to exit the property 4 to 5 years and give capital appreciation. A REIT, on the other hand, capital appreciation might happen based on stock price appreciation, but that's not the intent of a REIT. The intent of a REIT is really to give you rental income. So that's the primary difference. So in a product like ours, yes, you're investing for rentals, but you're expecting the appreciation at the end of it. So it's more in line with private equity real estate than a REIT.
So there's like a fixed time limit of the investment. It's not like a perpetuity thing. You are very clear right from day one that you're buying in, and in a couple of years, this will get sold and the money will come back to you with capital appreciation. And in the meanwhile, you'll keep getting a share of rent.
Absolutely. So that's the basic intent of that.
Got it. Okay. And how does capital appreciation happen in a REIT? Does the price of that lot get updated based on the estimated market price of the underlying real estate assets? Or is it like a traded thing and therefore there's a discovery of price happening?
Yeah, anything that is listed operates the same manner based on demand and supply. So the underlying fundamentals really are no bearing, even in companies, in anything that is listed. Look at how certain IPOs are performed now. They were valued at a certain price, of course, not accounting for the fundamentals. And similar in a REIT, I mean, to give you the converse example, at the start of COVID, at the embassy REIT, everything went according to plan. There were no changes in rental collection. In fact, they got 100% rental collection. The stock price fell by 30%. Why did it fall 30%? Because of retail investor speculation. Precisely. So that's how it is.
So that way, then REIT is not like a mutual fund, because mutual fund price is not determined by demand supply pressures, but it is calculated based on the underlying equity on a daily basis, like the NAV.
But yeah, the value of those equities are still speculative. So at the end of the day, you can say it's derived speculation, but all these things are, I mean, tomorrow there's a sell-off. All of this will come now.
So REIT is sold on NSE, BSE like a regular share?
Yes.
So essentially REIT is like an IPO only then, because you're like listing the shares of it. Okay.
So what happens when a portfolio becomes too large for a single investor to exit? Take embassy, for example. No single investor can buy a portfolio. So what then they do is they read it so that they also get a means of liquidity. Otherwise, what do these developers do after aggregating this portfolio?
Okay, so a REIT comes in when you already have the assets and then you go out and list those assets rather than collecting money to buy assets. That's not what a REIT is.
Correct.
Got it. Cool. I understand. So which is again another fundamental difference. Like in Myre Capital, it's not that you already have an asset and you're monetizing it by allowing investors to come in, but you're identifying assets and then inviting investors to come and fund the purchase of that asset.
Yes.
Got it. Cool. And so help me understand your 0 to 1 journey. So you had an idea to do something like this. How did you proceed then? Were there any kind of regulations in this space? Did you need some sort of approvals? How did you actually go about building that pipe for an investor to have just one small share in that overall thing? How did you do all of that?
So the first things that we did is that we got a very solid legal framework around what we were doing. So we appointed a tier 1 law firm, Akshay, and that was the most time-consuming part. So that actually made the idea real. So 6 months of work with CAs and legal, helped bring to life an idea in the current drilling structures.
And when is this? Like when you started working, which year? Just to establish timeline.
1.5 years ago, I think we launched our platform. So It's roughly about 2 years ago. So we started all this work about 2 years ago. It took 6 months just with legal and accounts.
Right, like early 2020 is when you started.
Yeah, roughly. Once all that work was frozen, then we slowly started recruiting, and we didn't recruit 10 people to begin with. We just started with 2 people, and everyone did all the work. So that's how it initially was. And rather than trying to perfect our product, we thought that let's just put out something which works and let's do a proof of concept. So that's how we went about it. We did a proof of concept which went well. And after that, it was just pretty much all organic growth.
What was the result of appointing the law firm? Was there any kind of a regulatory approval that you secured, or was it just to understand that, okay, what I'm doing is allowed?
No, so since it's an investment, there is an investment structure, there are investment documents, companies act compliance, there's private placement compliance. So all of these documents have to be done and templatized, which is what we did with our legal firm. We understood how we fit into those frameworks. What are the limitations? How do we get around the limitations? Because in India, there are many structures in which you can do everything. Choosing the best one, figuring out, because it's not that one is necessarily better than the other. It's who is your target audience and what would be best for them. So that's what we have to figure out.
So help me understand what you learned, that what structure is best here. Like, give me some details.
Sure. So there are many structures. There's an LLP structure. There's a private limited structure. There's a lot of types of taxation. You can do house property tax, business income tax. There's many permutations and combinations. So we sat down on Excel. We went through it one by one, and we eventually just figured out a structure that, number one, for Indians, what is most important is a sense of security with their investment. So that's what we prioritize. So we chose a private limited. It gives that comfort over an LLP. And second is that people want monthly cash flow. So we created a product that had pass-through taxation, which enables them to optimize tax in their hands. So these are all choices that we made. And all the documents and everything took a lot of time to prepare. We had to figure out that since there are going to be many investors, how do we ensure that one investor's liabilities don't pass on to the next? So all these kinds of clauses have to be developed. We had to think from the shoes of an investor. And effectively, that's what took place.
What are you selling? Are you selling shares in that private limited company, or?
Yes.
So, okay. So every investment opportunity is a new private limited company whose shares are sold. So therefore people have ownership.
Yes.
Got it. So each time you identify something, then you would first go about creating a private limited company to raise the funds to acquire it. And once you hit that target number is when the company would go out and buy that opportunity, that piece of property that you want to acquire.
Absolutely.
Got it. Okay. And the people, so these are people who are now owners of a private limited company, but then in private limited company, you don't exactly have liquidity to sell your shares of a private limited company. So what is so they can't sell it off until the project is finally sold and that cash comes back?
No, we have a secondary market like NCDs and LDs. Most debt products in this country are not traded on the listed market. They're traded on a secondary market.
What is NCT, MLD?
These are all debt products, not convertible debentures, market-linked debentures. These products are not traded on a stock exchange. They're traded when binding a substitute buyer. So when you basically replace one buyer with another, it's called a secondary market. And similarly, we have a secondary market. And we've seen a lot of liquidity, being able to get liquidity so far in under 24 hours, 21 only.
And so you said that you launched with a proof of concept. So that meant that you identified one property and you launched it, like in terms of getting a private limited company up to invest in that one property and then finding investors.
Correct.
So tell me about this first project what was the project you identified? What was the price of it? And how did you go about finding the investors for it?
Sure. So the first project was based in Pune. It was in Magarpatta city. So Magarpatta is a very well-known development, not only in India, but globally. In fact, there's a Harvard Business School case study about this township. So it was a very unique opportunity. Properties like this usually don't come onto market. They are owned by institutional funds, especially insurance funds.
So Magarpatta is like the location is premium. That's what you're saying?
Location is premium. It's a captive township. So you have 12 commercial buildings surrounded by all occupied residential. So a lot of them work in those 12 buildings. So these 12 buildings have never been vacant. And the tenancy profile is fantastic. The whole property checks all the boxes. So when we took this on, it was a 25 crore odd project. And we took a leap of faith. We took it. We started funding.
So when you say you took it, what does that mean? Like
we signed a term sheet for the funding of the project.
Okay. Okay. Which would make it legally binding for you to then provide the money. Now the clock started ticking for you to go and get the funds from the investors, basically.
Yes.
And what is the period of that clock? Once you sign a term sheet, how long do you have to collect the money?
It varies deal to deal. In that deal, it was about 3 months, I think.
So 3 months is like pretty high stress though, right? Like you're on the hook for 30 crores and you need to find investors.
Yeah, it wasn't easy. And yes, it was a lot of work, but we figured it out. I mean, month number one, I don't think we did more than 25 lakhs. Yeah. And then,
Wow, you must have been sweating bullets. Huh?
well, the thing is, yes, we were sweating, but we also kept figuring out what we were doing wrong because we were getting a lot of positive response, but the conversions were not happening. So we were figuring out what is wrong. Who's our audience is. Initially, we were targeting real estate investors and ultra HNIs, but what we realized is the ultra HNIs don't need us. They can go and buy the property themselves for 25 crores. So then we switched to salaried professionals, especially lawyers, CAs, and that's where we found our ways. You can say retired individuals, NRIs. So, this is the segment we went after, and we actually completed the funding, I think, 48 hours before our deadline. So yeah, we got it very close. We had a very small team, but we were through and through, I think, 3 months.
Okay. And how were you doing customer acquisition? Was it like Google, Facebook, like performance marketing, or was it like telecalling, or what was it like?
I mean, at that time, we were going and finding, because once we converted 3-4 CAs, we realized that CAs are a great target audience for us. We went on LinkedIn and just started.
Because CAs understand that the value of that investment.
Yes. So we went to LinkedIn, we started finding CAs, cold calling them, we started finding lawyers, cold calling them. Eventually, we realized that, and we aren't just starting our whole digital outreach like we have today. We did have a couple of leads coming, but that was very insignificant. So word of mouth, we reached out to every broker in the city. We went to chat with them. We shared our earnings with them. We told them that, listen, let's do this as a team together.
Why would a broker help you? Because brokers know HNIs. That's the logic.
Yeah, of course. I mean, their job is to raise funds for properties. So effectively, this is a different kind of opportunity. So it would give them also variety in their offering. They've been selling the same thing now 20 years. That for some it's working well, for some it isn't. So for the ones that it wasn't working, those guys were very open to try new things.
And you would share some commission with the broker.
Yeah, we told the brokers that we were making whatever amount we were making, we were happy to share that with them. The idea really was to demonstrate that this whole market exists. So more than making money at that point, we were okay giving our entire fee up also, because the goal wasn't to try and make money off our first project. It was to demonstrate that this could happen.
If you like to hear stories of founders, then we have tons of great stories from entrepreneurs who have built billion-dollar businesses. Just search for the Founder Thesis podcast on any audio streaming app like Spotify, Gaana, Apple Podcasts, and subscribe to the show.
This is something which doesn't really need you to go to a VC to raise funds as such, because there is no, there's no heavy upfront costs here.
Well, now today, if you ask for a team of 20, we have our office space. We run heavy amounts of marketing campaigns, PR campaigns. There is a lot of cost associated, but we've always been very cognizant of our P&L. So we will ensure that our P&L remains strong. It's something that doesn't go out of hand, where, in the chase for growth, we start ignoring profitability. So we've always, as a company, gone a bit more conservative, but we try to remain sustainable. And yes, VCs have approached us. We quite often entertain the offers as well, but the whole premise is that VCs usually want to come in initially so they can get a large chunk and help out the startup. The point is that because we were having a strong BNL, we never wanted to give away at a distressed valuation. I mean, the need was never really there. Even today, we get a good offer, sure, we'll consider it, but there's no requirement as such. We are breaking even in the next 30 days.
Help me understand how this property gets managed, how you monetize. So you bought like one floor or one building. What did you buy for 30 crores?
I mean, each project, like I mentioned, is different. And in these opportunities, in these institutional grade opportunities, 30, 50 crores gets you one floor at best. But you're not like small projects. So you buy a floor plate. The other owners in our building were Man's Life Insurance, PNB MedLife. So all institutional funds. But yes, our first one was a floor.
Okay. And how, what next? Once you bought it, how is it run? How do you manage it? Tell me about the logistics of making this work.
Sure. So we have an in-house asset management team. We have someone who looks over tenant relations. So we often identify the tenant before purchasing the property. That way, rental comes in from day one. So in all of that, we have a very capable asset and in fact, very experienced asset management team in house now. And they look at all this post sales management.
What you raise from investors includes some cash in hand because you may need to spend on fit outs and stuff like that. So you would need some cash in hand, right?
So in fact, we price in all our costs upfront and we don't spend a single rupee on fit out. We make the tenant spend all the money. So that way the tenant stickiness is also there to the premises. So that's in fact one of our primary conditions, that the tenant has to also put his skin in the game. I mean, he can't expect us to sign a 15-year lease having no commitment to the premises.
Okay. So what you raise from investors, there is no cash in hand left for you. It is all going towards purchase of that property.
Yeah, we keep a minor reserve of 10, 20, 30 lakhs, but not more than that.
Okay, which is just like a contingency fund if there is any maintenance expenditure needed or something.
Absolutely.
And the building maintenance fees and all that is recovered from the rent. Like all the running costs that you would incur as the owner of that property.
We make the tenant pay everything.
Oh, you make the tenant pay. Okay. So there is no running cost for you as such. You just have to collect the net rent amount from the tenant.
No, so I really think good tenants want good buildings, and having good buildings in a time like this gives us the advantage that we get our terms. We of course give them things in exchange, but all our terms are based on one basic principle, that we need to increase the tenant stickiness to the premises so much that he can't think. It's as simple as that.
Essentially, for a tenant, you want to convert this into subscription-based ownership instead of just plug and play, rent today here, rent tomorrow there. You don't want that kind of a business.
Yeah, I'll give you an example. Now we're buying a property in Bangalore, which is we are paying 8,000 rupees a square foot. The tenant is doing fit outs which are valued at 3,000 rupees a square foot. So he's almost paying 30% of the property price on fit out. So he has to be there for 10, 15 years. I mean, if he leaves before that, it's not going to make sense.
This private limited company which owns this property, so do you also retain some ownership in that, or everything is owned by the investors?
Not everything is owned by investors. We are simply the managers. So we charge an asset management fee. Like you were mentioning in mutual funds, it's 2%. In REITs, it's 2%. We anywhere between 0.5 and 1%.
Why do you not charge the industry standard 2%?
Because we basically are doing everything tech-based. So all our lead gen is tech-based, our conversions are tech-based, investor onboarding is tech-based. They're saving a lot of money relative to what the industry operates on today. So we pass on a little bit of that benefit. The whole point of using tech is to disrupt the norm. And 2% is something we don't need.
Plus, there is no active portfolio management. Say in equity, you are actively doing portfolio management, turning stocks and all that. Here,
in real estate, it's actually a little bit different and in some sense a little bit more intricate because we're signing legal documents with tenants, landlords, day in and day out. I mean, when lockdown came, we still maintained 100% rental collection rate. So despite tenants asking for discounts and things like that, because all of it takes planning. So we have, for example, solicited offers from other tenants for that same space. So when a tenant had asked us for a discount, we told him either you leave, we have this other tenant, or you stay and pay. Preempting those things requires active management.
If there are legal costs incurred to collect money and stuff like that, so that will be adjusted from the rental income. If it is over and above that contingency amount which you've kept, like you may end up needing to.
No, we keep a provision for everything. Even legal has a provision day one, and we count all that. So before acquisition, we complete all our legal work.
No, but to collect rent, you might need, like there could be a case where somebody defaults and then you need to use legal methods to recover and like those kind of things.
No, we take a 6-month deposit from our tenants.
Okay. So that default risk is not really there. Okay.
Yeah. So we use the tenants' money to figure out the solution.
Nice. Okay. And so that was like first project, what you did. Now tell me how your own way of working, your systems, your processes, how they evolved from project 1 to project 2. What was project 2 like? What was the ticket size of it? And how many days did you have then? And how long did it take you to collect all that money? And
yeah, so project 2 was again about 35 crores or that. In fact, we took about 4 months of downtime after our first complete project. In those 4 months, what we understood is the different processes and how we would automate them. So a lot of tech work went on behind the scenes.
What processes did you automate? Help me understand.
Everything which involves the investor. I mean, all the KYC, document signing, onboarding, post sales, investment tracking, performance tracking, rental collection and disbursement.
Okay, like giving them a dashboard.
Yeah, then receipts, issuing receipts. I mean, every small thing which quite often we see on other platforms, we think is just part and parcel of that platform, but a lot of tech goes behind all of it. So just thinking out that whole flow and implementing it, that was being done, plus hiring, because earlier we had 2, 3 people who had done everything, but that's not a sustainable way, especially in the longer term. So we hired quite a bit.
What kind of people did you hire? Like for doing sales?
So there's no one called a salesman in Myre. We, in fact, everyone has 2, 3 positions, because at the end of the day, we have periodic sales cycles. So when we have 2 months sales, 1 month we don't. So most people do content writing, strategy, fundraising, business development, recruiting. So, everyone does a variety of things. It's not restricted to sales.
Fundraising would be like sales, basically, right? Like somebody who's doing fundraising.
You can say to some extent, but it's more to do with business development, where you plan webinars, we plan launch events, PR strategies. So it's more to do with strategy. And the thing is, we mostly do inbound. So it's not as though we have deep sitting around calling people all day. We mostly do inbound only. So when someone is interested after seeing our digital approach, so we do automated emailers, SAM automation, all of that. And once someone expresses interest, then we just simply speak to him for a matter of 15 minutes, and he can complete his onboarding himself online digitally.
And how do you take the money? A payment gateway or a bank transfer?
So we do bank transfer, because payment gateways can't process the size of transactions that we're doing.
What is the average size per investor?
Minimum size 25 lakhs.
So like you spent a couple of months in putting these workflow automations in place and then building your team. Then what was project 2?
Yeah, so then we doubled down on all these things. That project 2 we launched in Mumbai, was in right next to the airport in a new building called Times Square. Our tenant was a subsidiary of RBI, so fantastic tenant. In fact, they're the technology vertical of RBI. So they were the essential services, in fact, at COVID, so no problem there also. But overall, it was a very unique opportunity. We ended funding it in well within time. So I think 2.5 months or 2 months we took to fund the peak, which was a significant improvement. And we also did it far more streamlined. I mean, there was no stress, no pressure at any point. We were always in a good spot. And we've done quite a few projects thereafter. Now we are doing a project in Bangalore. This is the most ambitious one.
Which project number is this, which you're doing now?
So this should be about 5.
Okay. And just quick summary of projects 3 and 4. 1 and 2, you told me. What was projects 3 and 4?
Yeah, so project 3 again was in Magarbatta only. So it was the same seller. So we had told them we'll only buy half, and then he sold the other half also, because we could digest it. And the other project was in BKC in Mumbai. So that was also something which, in fact, we sold 20 crores in 48 hours. So that was our flagship achievement. Right now, we've taken the most ambitious project we've ever taken at close to 75 crores.
Wow. Okay. And where is this? Tell me about the current project.
It's in Bangalore. It's in Outer Ring Road. Hopefully, the funding should be complete by the time this ends. It's a brand new development called Vaishnavi Tech Park. Tenant is Grow.
Grow. Okay, the unicorn.
Yeah, it's the corporate headquarters. And again, this is a business which only grows in pandemic. So this was something we thought was discovered to the client. Plus, they're investing heavy amounts of money into the premises, because, they're building the office, not like a normal office. They're putting escalators. They're putting a lot of very fancy stuff. So they're not leaving the space for a very long time.
Okay. And do you see repeat buyers, like someone who invested in project 1 would also invest in project 2? And what rate does that happen?
Yeah, absolutely. In fact, we have a very high repeat investor rate, especially for the ticket size of 25 lakh. 25% of our opportunities get funded by existing investors. Yeah, even this time out of 70 crores, we roughly funded 5 crores from existing investors.
So as your investor base increases, it gives you that confidence that you can raise funds more quickly, because you know that a certain percentage of your investor base will come and invest in the next project.
Absolutely.
What are the ways in which you are acquiring customers? One you said is like webinars. What else?
So we do a lot of content-first marketing. So we do a lot of PR, publications, educational pieces, awareness pieces. Apart from that, we get a lot of referral or word of mouth investors. We started tapping into NRI publications of recent, which has been great for us. And of course, we follow the mainstream performance marketing. So all of that we do as well.
And the way you make money is just that 1% management, 0.5 to 1% of management fees. That is the only way for you to make money. There is no other way.
No, we have a performance fee also, which we charge at the time of exit of the property, or when the property is sold, but we only charge it above a 12% IRR. So that's above a 12% annualized return. If the investor makes any surplus money, then we charge a 20% profit share. So 80% of the investor still keeps.
Okay, which is like the standard PE hedge fund kind of a norm, or even VCs.
Yeah, and so normally Bs and VCs charge above 8%. So it's the main difference. So we charge above 12%.
Okay, above 8%. Okay, got it. And what do you think is going to be the life or the tenure of any of these projects? Like, when do you think that liquidation event will happen?
So it was projected preemptively based on current market scenarios. Of course, it can fluctuate plus minus. But our earliest one, we projected exits in 2025.
Okay, for the project 1, or project 1 and 3 are the same building only, I guess. So one of
Yeah, so project 1 and 3 are in 2025. Project number 2 is, I think, 2030. So it again varies. It depends on the property, the specifics. There's no such hard and fast rule.
Is there democracy in deciding whether to exit or not? Do you need to secure majority approval of the investors before you sell, or like, how does that happen? How does the exit event or the liquidation event happen?
Yeah, absolutely. In fact, we solicit offers from the market. What we have obviously presented to the investors. 75% or more give us the go ahead to believe that we exit.
And the exit would involve selling the property, getting the cash back into that private limited, giving the cash to investors, and then winding it up.
Yeah.
Got it. Okay. Got it. I've understood the full cycle. Okay. So how big do you think this space is? So currently you are doing a 70 crore project, and you do what, one project a year, two projects a year? What will be your...
I'll tell you. So last year in 10 months, we did 150 crores across 4 projects. This year, we've already done, 70 crores is what we're doing right now. Our target this year is about 300 to 400 crores. So we're looking at doing 5 or 6 projects this year. And next year our target is 1 a month. So it depends on the sales velocity, depends on the kind of supply that we get access to. But we are seeing strong demand. All our opportunities are being oversubscribed. So overall, currently demand is not the problem. We're just trying to build velocity.
So you would end up doing 1,000 crores total deployment next year, and like maybe 1,500 crores after that, something like that. That's the kind of growth rate you're seeing. By say 4-5 years down the line, you're looking at what, 2,500 crore annual deployment.
Not annual. I don't think this money can usually do more than 500 to 1,000 crores, because at the end of the day, these are still retail funds. So there is a barrier into how many people will do 25 lakhs like this. So what we are trying to do is that by the time we hit 2025, we want to give exits. Once we deliver on what we projected, so those investors more often than not will reinvest that same fund with us. So effectively, our AUM base will never really go down.
Okay, so you want that liquidation event to happen when you also have fresh inventory to offer to that same pool of investors.
No, absolutely. In fact, the intent is to always keep a property live on our platform so that investors always have something or the other to dabble with. But yes, if a liquidation event happens simultaneously, then nothing like it.
So with, say, if you have 2,500 total assets under management, so your earning would be like a 1% of, so like about 25 crores would be your top line number.
Yes.
Got it. Okay. So what's like the long-term roadmap for Myre Capital?
So we're coming up with a few more interesting investment products. So we're diversifying our product offering. Again, that's something which is a work in progress. So we're still evaluating the risk return proposition, if this is right for our investors, things like that. But that is one of the areas in which we're looking to grow.
What are some of those ideas that you're mulling over?
So different investment in real estate comes in many shapes and forms. You can go under construction, you can go vacant property, you can go into land, you can go into many forms. And each has if you go into land, you'll have a much higher return projection, but equally higher risk. And if you go into under development, maybe slightly lower return, but slightly lower risk. So, it's a scale of risk and return. There's nothing which comes without risk and high return. So bringing that to investors in a safe manner is what we're contemplating, because at the end of the day, risk is risk. So it doesn't matter if I'm managing it or someone. If it's a third party risk, then that risk is there. So just trying to figure out how we can accommodate that, how we can position it, if there is an appetite for it. So all these things we evaluate.
So if you were to go with land, then you would construct, or you would have a developer, like you would fund the land for a developer who would construct and then get it ready?
The point is, first you have to be okay with getting into under construction to begin with, or getting into plot finish to begin with. The structures that you can explore are many. But the fundamental question is that, is it okay for us as a platform, even if we explore the risk, to position something which potentially has loss of capital risk, even if the upside is however large? That is the fundamental question which we are working on, to say if there's a way we can do to control risk. But once that is addressed, any number of models can be fit into the system.
I'm guessing that the key lever to unlock, or the key constraint to growth, is supply, right? If you're able to get supply, because there's so many things which have to fall in place for good supply, like you need the right location, you need a well-made building. So you need a developer who has good credentials. You need a tenant who is interested in that. So I'm guessing that your primary constraint would be supply, not demand, right?
Well, supply is, well, it was a constraint. We're getting better at it because the thing is that supply is not something which ever comes to you in a planet. It's like you mentioned, it's a mix of moving parts. So, we're becoming better at finding good properties and independently finding good tenants. And then we try and put those two together and effectively create a supply. So it's an ongoing thing. Our tenant relations have expanded. Our developer relations are expanded. We're in discussions for future projects. Like I know we are closing on terms for a building that is completing in 2024. So I'm creating a pipeline for even the future. The developer gets certainty today that he has a buyer for that project. So he also can take more risk maybe today and expand and do one more project. So with that visibility, he's able to plan his cash flow and I'm able to plan my pipeline. So that kind of arrangements we are setting up because yes, supply was challenging, but it's important to build that pipeline preemptive.
Okay, got it. So what's the path to like getting to a 100 crore annual revenue business?
So I have always, in fact, told my team also that revenue really doesn't matter. What we are looking for is profit because, revenue doesn't imply really anything. So being large and making less money is not ideal because one way is to go after growth, but we want to do growth, but with PL. So our intent is to maintain a very lean team. Maybe right now at 20, we'll expand to 30, but not more. And even at 25 crore top line, we are highly, highly profitable. So our intent is also to try and target 100 crore revenue.
What would be the profit at a 25 crore? Like a 10 crore would be the profit there, I'm guessing. Your expenses.
Maybe higher than that also.
Okay. Your expenses might be at best like 1 crore a month, I'm guessing. And that's it.
We break even at we will break even at full capacity at, let's say, 6 crore spend a year. So, I don't need a top line. All I need is profitability.
And you are the sole founder here. It's 100% owned by you.
Right.
Amazing. Okay. And so I guess it makes no sense to even look at fundraise VCs because you have no need for it, right? You are almost at break even. By the time this airs, you will be breaking even and your costs are not going to rise exponentially. There's not a direct relationship between revenue and cost. It's not like for every 1 rupee more of revenue, your costs have to go up by a corresponding percentage.
Yeah, that's actually the best part of this business, that your costs are not linked with revenue.
Your costs are more or less fixed and revenue can keep growing on that same base. Amazing. Okay. Would looking at the future, would you have more business, as in more investors coming directly, or would there also be like a channel through which you acquire investors? Like the first time you did it, you used broker network to acquire investors. So do you think that the channel contribution is going to be significant in the long term, or it will be like direct acquisition that will be more significant?
So we've actually, the most successful for us is neither. It's actually referrals. Referrals have been the strongest signal point of conversion. So that's something which we are keen to expand on. We get a lot of direct investors also, especially from a lot of our content plus marketing that we discussed. But through our other distribution channels, we're keeping them open. We are getting traction from them. But the idea is to eventually, at least for repeat investors, become a DIY platform. Because I know, initially for someone who put in 25 lakhs, it's difficult to DIY. But repeat investor, you know how it works. Then we eventually want to become a DIY platform.
Okay. So the distributor-led acquisition would be pretty minimal because this is only like a one-time bringing in customer job that they would do. But as your existing base grows, the repeat purchase increases, the referral increases. So that would be a pretty marginal source of investment that going through brokers and other distributors.
Well, I'll put it another way. We have a team that manages partners, which includes wealth managers, IFAs, brokers, even some CAs actually. And we are continuing to wrap that up because we don't know what the future holds for us. Today we are doing a 70 crore property. Let's do a 150 crore property. Then every last rupee of one, irrespective broker, non-broker, direct referral, all of it is important. So you're not disregarding the importance of any sales funnel yet. But the future, based on current trends, referrals are going to be at the very lead, followed by partners. And
what is the role of technology here besides the automation of your workflows? One role of tech is to automate workflows, make things DIY, move things along smoother. What else? Any other role of tech here?
If I was to onboard 200 investors into a real estate property, it would take me 2 months of paperwork. We democratized it, all the signing is digital, and for that matter, all the post-investment reporting. So all the reports that you might have seen, the mutual fund and everything, that everything is fully end-to-end automated. So that's why we are still in team. You can say 50% of the work gets done by humans, 50% by tech. Because quite often people mistake tech for what they see on a website, but tech really is something which helps you reduce cost via means of automation. So a lot of our tech is on the operations side, back-end side, and that tech is far more valuable to us today than, let's say, the tech which is what the investor is releasing.
So there is this growing trend of remote work. So doesn't that concern you, like from the perspective of commercial real estate losing its sheen? Because maybe companies don't need big offices now. They would have a lot of their headcount working remotely. What do you think about that?
Sure, so I'll talk a little bit about the trends in the industry in a minute, but I'll tell you how it actually impacted us first. For the first 2-3 months, it was a fantastic solution, work from home. All the employees in the whole team was very happy. After that, I started getting complaints of fatigue. I started getting complaints of, space at home from my employees. And eventually, everyone wanted to come back to work. So what we did instead is, even in lockdowns, we did this concept called work from work. So effectively what that meant is that we all booked out a villa or a apartment or hotel and we quarantined together, we worked together. So that's the extent people go to, because for us to do good work, for people to innovate, to come up with solutions that have not existed before, it's important to be in a collaborative environment. Sitting in one house with Toronto was conducive of spaces. So overall, that's the perspective we have. But even in the industry too, we see leasing has picked up to pre-pandemic levels. Large organizations are coming back to work. And contrary to expectation, what is now happening is that earlier the area per employee that was being dedicated by MNC was roughly 40 to 50 square feet. In a post-pandemic world now, MNCs are mandating 75 to 80 square feet. So the consumption per employee is decreasing. So someone who was occupying one floor earlier is now actually trying to occupy 2 floors to accommodate the same number of rooms. So that's a trend that is actually causing a really massive uptick in the demand for office space. I mean, only last week, if you see IBM, Concentric, Accenture, all of these tenants are back in the market with RFPs.
Okay. TCS had made this very bold statement at the beginning of pandemic that they will be 100% remote in a couple of years. You think that was just like over enthusiastic announcement? I don't think they're actually going that way.
No, I mean, to the contrary, TCS is back in office. They've taken a full campus from Hiranandani and Thane. So yes, work from home at the start of COVID sounded great. It also was a solution to provide long-term comfort to employees. I mean, when you have uncertainty in organization, that is worse than having nothing. So at that point, I guess organizations felt work from home was a solution that would at least guide them out, a year or two. But today, I don't think there is a single employee which will tell you that they want to work from home in perpetuity.
Got it. And do you, what about co-working spaces? Have they recovered back to pre-pandemic levels? Are you aware of what's happening in that space?
No, absolutely. In fact, so co-working as a concept in itself is something which I'm wary of, where you're catering to individuals or small startups. What is a more promising trend to see is the concept of managed leasing. So that's an evolution of co-working. So in managed leasing, the concept really is to make a fully managed office, but for fully enterprise clientele. So someone like a Microsoft, Amazon would take up large amounts of space. So SmartWorks, IndiCube, these are some of the players, stable space that have pivoted from co-working to managed leasing. They don't want the risk of a single person. They don't want the risk of a small startup.
So the difference between co-working and managed leasing is the ticket size. Like co-working would be single seat or 5 seats. Managed leasing would be 50 seats or 100 seats. That's the difference.
Yes, and with that comes implied differences also. For example, working the whole model is made for single seat, but at high cost and high luxury. So you go to a WeWork, you'll probably in Mumbai end up being 30,000 rupees. But you get that kind of amenities. Now, enterprise clientele doesn't need it and also doesn't want to pay for it. So comparatively, our managed leasing operator SmartWorks. In the adjacent building, SmartWorks is offering seat for 6,000 rupees. So that's the kind of price you have to get. So it's a completely different model that comes out of it. Whereas, yes, the face value difference only is the type of tenant and size of tenant, but it has many implied consequences that result out of it.
And probably there'll be a lock-in period also with the managed leasing contract. Like it's not like month-to-month payment.
Absolutely. In fact, 5 years.
5 years. Okay. So essentially it's like regular renting an office, except you don't have to worry about the day-to-day running of it. There's someone who's taking care of all the ancillary stuff. Your people just come in and work.
Absolutely.
If you like the Founder Thesis podcast, then do check out our other shows on subjects like marketing, technology, career advice, books, and drama. Visit thepodium.in, that is thepodium.in, for a complete list of all our shows.